Hello everyone and welcome to Regards Experts, your show that regularly brings you in contact with researchers. And this month, we are joined by Jean-Philippe Bouchaud. Jean-Philippe, hello. Hello, Issa. So, you have a bit of a dual role. As you are both a professor at École Polytechnique and also the president of one of the largest hedge funds companies, CFM. Well, yes, but I am truly a researcher at heart. I love teaching. So, being a professor at École Polytechnique is a necessity, almost like doing gymnastics. It's important. There is a contact with students that is also very important to maintain motivation, keep an eye on fundamental research, and obviously attract young talents to the company. So, for me, there is no contradiction at all. Moreover, CFM is truly a company that, from the beginning, has sought to marry research excellence with rigorous management. So, for me, there is no contradiction at all. Now, this link between your two activities, so to speak, is also evident in the latest article you wrote. As you drew from your experience at CFM where you place a large number of orders every day and you realize that you often need to fragment them. Can you explain that? Yes, it may seem surprising because one would think that in the most liquid markets on the planet, you can place an order without any problem, especially for a company as important as CFM, which is still tiny on a global scale. But yet, if you want to execute even a small quantity, let's say 1% of the daily liquidity traded on IBM, Apple, or any other company, 1% is not huge. But still you cannot execute your order immediately. Just to buy, there is no seller for 1% of the daily liquidity immediately. You have to retry about 50 times, let's say, to find that liquidity in the markets. So, what does that mean? Does it mean that liquidity is very low in the immediate term? It's a bit paradoxical because we often talk about the gigantic orders placed today. Well, that's the funny thing, the most liquid markets, in fact, are instantly very illiquid and acquire liquidity as the day progresses. That is, it is as transactions take place that more liquidity returns to the market. You really have to imagine the markets as a kind of hide-and-seek game between buyers and sellers, if you will. But then, what are you saying? Does it mean that transactions feed on themselves, so to speak? That is, the more transactions there are, the more liquidity there will be, etc. Yes, because buyers try to figure out what sellers want to do, and sellers try to figure out what buyers want to do, it's normal. Neither of them wants to buy too expensively or sell too cheaply. I see. And in your study, you also analyze the impact of these meta-orders, as you call them, on price movements. Can you tell us more about that? Yes, that's absolutely crucial, actually, because, as I mentioned earlier, we have to fragment our orders into several pieces. So, at different prices. At different prices. And the real question that arises is how much, in the end, we will have paid compared to the decision price, let's say the starting price of the day when we would have wanted to execute everything. We fragment our order. And the interesting and somewhat counterintuitive thing that is difficult to measure is that each transaction has an impact on prices. That is, on average, buying pushes the price up, selling pushes the price down. Regardless of the size of the transaction. So, as we transact, as we cut our order into small pieces, we push the price and gradually end up paying more and more for what we could have bought as a single block in the morning, paying less. So, this impact is crucial for two reasons. First, it is this impact that moves prices. It is the aggregated impact of all actors in the market that causes prices to behave erratically, as we can see. It's the alternating influx of sellers and buyers that moves prices. But on the other hand, this impact is a cost. And it's difficult to anticipate the cost price. That's what we tried to measure precisely, by averaging over a very large number of transactions we could make at CFM, how much it costs on average to transact on the buy or sell side. And we established a law that relates the impact of a transaction to the volume we want to transact, that is, how much we want to buy and how much we want to sell. And what is absolutely extraordinary is that this law depends on practically nothing, meaning it is universal once we take into account the volatility of the underlying asset we want to buy, the financial instrument we want to buy, and its liquidity. Once we have taken these two parameters into account, the law itself depends on nothing else. That is, we observe the same pattern on all stocks, whether in London, Paris, Tokyo, Australia, as well as on other financial contracts. It's exactly the same mathematical formula that describes the impact of an order on prices. And what is truly remarkable is that this impact is not linear. If you want to transact twice as much, you will not impact the price twice as much. You will impact it less than twice as much. Oh no, it's not exponential, it's the opposite. No, it's not exponential, it's the opposite. And if you understood my little story earlier about the hiding buyers and sellers, but in fact, the reason we try to mathematize, to understand precisely, is that the more we buy, the more we push the price up, but therefore the more the sellers on the other side are interested in selling to you. And so, by buying, we reveal the sellers, who are more numerous at the end of the day than at the beginning of the day. So, it should regulate the price. And it effectively prevents the price from going too far. And so, the more we buy, the less we push the price in a way. Well, I believe your thinking doesn't stop at this article, since you are part of the organizing committee for a major event on market microstructure that will take place in December, if I'm not mistaken. So, what is it about? What is this event? What are its ambitions? Who will be invited? In short, tell us more about it. Well, this event is actually the second edition, in a way, the second edition of a conference we organized for the first time in December 2010, called Market Microstructure, confronting many viewpoints. And the ambition we had the first time, which I believe was a true success, all the participants spoke highly of the event itself and its organization, was to bring economists, financiers, mathematicians, computer scientists, physicists, people from the academic world, and people from the practical finance world together in the same room to discuss market microstructure, that is, the science of price formation. So, a very interdisciplinary conference. Very interdisciplinary. And on a topic that is very important, because price formation means understanding why prices move, but it also means understanding how to engineer a fluid market, what can be the impact of a financial transaction tax, what is the impact, for better or worse, I think for the better. But it is obviously a matter of debate, of what we call high-frequency traders. All of this is part of this field of study, which is actually quite recent, as microstructure as a scientific discipline has only existed for 15 or 20 years. And in fact, it is the emergence of data, high-frequency data, that has allowed this science to develop, but it is still very young. 15 years for a science is very, very young. But it is crucial because it is still the key to your profession. Absolutely, it is crucial for many problems, regulatory problems. Problems of understanding what financial markets are, what they do, their instability. So, it is very important to bring together people from very different backgrounds to discuss these issues. And so, for the second time this year, we managed to gather a very impressive group of scientists, as well as industry professionals. In particular, we will have two international stars from the academic world who are truly renowned. Joël Asbrook, who is a professor from New York, who wrote a book called Market Microstructure, which is a classic in the field. And Albert Kyle, everyone calls him Pete, but his name is Albert, I never quite understood why. He wrote the first model of the impact of transactions on prices. And to connect with what I was telling you earlier, the classic Kyle model is a model that predicts that transactions linearly impact prices. That is, the more we transact, the more prices rise proportionally. And as I explained to you earlier, we see something very different in the data. We see this saturation of impact. So, the confrontation of your viewpoints will be very interesting. We see that the confrontation of viewpoints is very interesting, and that the confrontation of empirical data, which is now available and accessible to us as an investment fund, and which the regulator should also have access to, is the confrontation between this empirical data and theory. Theory, often in the abstract, is very important for having good models because we can go down completely wrong paths if we don't look at the data. I think that's really the important thing. Jean-Philippe, thank you. Thank you to you. And to all of you, thank you for your attention. My friends. Now I want to talk about the pivotal impact of market orders on price volatility. This is an important concept to understand, as it ultimately shapes the price action in markets, affecting its volatility, and by implication, liquidity and volumes. There are three potential impacts, depicted by three distinct lines: a light blue line, a purple line, and a dark blue line. The light blue line signifies an impact that follows an exponential function. This scenario is generally encountered during the withdrawal of market makers. Liquidity gaps or spreads, or a reduction in the order book's liquidity. When a market maker exits, it can lead to sudden price movements and increased volatility due to the decrease in liquidity. Furthermore, in the case of liquidity gaps, we could observe sharp price movements causing a significant increase in volatility. The purple line, on the other hand, illustrates an impact following a linear function. It's an anomaly in the natural order of things and is largely an artificial construct, a figment of human conception. While it doesn't typically occur in real-world scenarios, it's a useful theoretical construct to understand the limits of market behavior and how human intervention can disrupt natural market forces. Lastly, the dark blue line denotes an impact following a square root function. This situation is commonly found in markets where there's absorption by market makers. This means the market maker absorbs the excess supply or demand in the market, allowing for smoother price changes and maintaining market stability. This has the effect of moderating volatility, making the market more predictable and stable. In conclusion, understanding these three potential impacts of market orders on price volatility is crucial. It helps traders and investors anticipate potential price movements, enabling them to make more informed decisions. Moreover, this comprehension facilitates an understanding of how changes in market dynamics, such as market maker behavior and liquidity conditions, can significantly influence price volatility. Remember, financial markets are complex ecosystems with various elements interacting. Recognizing these interactions and their potential effects can provide us with valuable insights into the market's future behavior, ultimately contributing to more effective and successful trading strategies. Thank you for your attention.